The Dodgers were seized and sold for $2.1 billion. How did this happen? $2,100,000,000, a $130 million divorce. Decades of using a championship franchise as a personal bank. The league stepped in. Control was stripped. The family lost everything. Listen to the numbers first. $2.1 billion exchanged hands under pressure, not choice. $130 million diverted to settle a marriage. Hundreds of millions more flowed sideways over years. Attendance slipped. Cash flow that paid players and kept lights on was pledged, lent, or siphoned. Those are hard facts. The consequence was immediate. The consequence was irreversible. Fans saw their owners replaced. Longtime staff were shown the door. A dynasty's name stopped meaning stewardship and started meaning litigation. A storied franchise became collateral. That is the story. We start now. They built a dynasty. The family bought the club with pride and patience. Championship banners followed. Stadium deals expanded the brand. Franchise value rose in big leaps. What was once a local treasure became a global blue-chip asset. The market's rush raised both value and appetite. Banks lined up. Advisors offered leverage. The family's balance sheet looked like opportunity. That rise hit a critical mismatch. Value is not cash. The team's market worth ballooned on TV rights, sponsorships, and future ticket sales. But daily operating cash is different. Payroll, maintenance, vendor payments, tax obligations. These require steady liquid flow. The family wanted access to the asset's value without selling it. They pursued methods to bridge the gap. Estate plans, loans, guarantees, informal intracompany transfers. Those choices converted a trophy into a liquidity machine. A risky decision followed. The club's cash flows and assets were used as collateral for personal borrowing. Family members and affiliated companies received loans guaranteed by the franchise. Short-term fixes were layered, lines of credit extended, interest rolled, refinancings executed. The logic was simple. The team's valuation will keep rising. Sell later. Refinance now. Keep control. Maintain the dynasty. Those are decisions. They carried consequences. Liquidity left the operating accounts. Interest and principal obligations piled on. Credit terms tightened. Behind the scenes, the ledgers showed intercompany transfers labeled as management fees, loans, or advances. Employees saw checks bounce. Vendors received delayed payments. The public only saw a winning team. Insiders saw a balance sheet quietly encumbered. For a while, the playbook worked. The club won. Fans filled the stands. Revenue rose. Media deals sent checks. The rising tide covered missing covenants and aggressive accounting. Banks renewed credit based on projected income and past performance. The family's pride distracted from structural weakness. Lenders accepted optimistic forecasts. Executives deferred hard choices. This period created dangerous complacency. Success on the field became the proof of solvency off it. Short-term cash maneuvers masked deeper stress. Every renewal of credit reinforced the belief that revenue would always catch up. That faith prevented meaningful change. Governance frayed further as family decisions outpaced corporate controls. External oversight was minimal and often symbolic. Then the first real cracks appeared. Covenant notices arrived. Lenders saw transfers between the club and family entities that weren't well documented. External auditors asked for explanations. A high-profile divorce made private financial arrangements public. The $130 million settlement became a lightning rod. Once confidential agreements surfaced in court papers, so did the ledger entries tying the family's personal obligations to the club. Those are the warning signs. The consequences escalated fast. Creditor patience shortened. Interest rates rose. Loan repricing accelerated cash burn. Public confidence wavered. Internally, morale dipped. Longtime executives received terse emails. Season ticket holders sensed instability. The club's vendors began contracting their exposure. Pressure turned into real losses. First, liquidity dried. The $130 million payout required immediate cash. The family moved to satisfy the settlement. Cash that would have covered operating expenses was rerouted. Payroll weeks were squeezed. The club scraped for short-term credit. Second, borrowing against the team intensified. More loans were taken. More corporate assets were pledged. The club's balance sheet became heavily encumbered. Lenders pushed for guarantees and tighter covenants. Those demands triggered further transfers and hastily arranged financing. Each step reduced flexibility. Third, formal legal actions appeared. Creditors filed suit. Tax authorities examined returns. Public filings revealed the scale of intra-company claims. The legal exposure added fees, holds, and reputational damage. The club, once a pillar of certainty, now had parties lining up to assert claims on its revenues and assets. The escalation was methodical. Small shocks fed larger ones. The divorce drew back the curtain. Lenders reacted. Lawsuits followed. The family's private fight had become a public financial contagion. At a tipping point, Major League Baseball intervened. Investigators found governance failures and conflicts of interest. Owners are required to meet standards of conduct and financial responsibility. The league concluded that those standards were breached. Operational control was placed into receivership. The board was sidelined. The family's authority evaporated overnight. The consequences were stark. The league appointed custodians to run day-to-day operations. Contracts with sponsors and media partners were reviewed. The club could no longer unilaterally pledge assets or make high-risk financial moves. An external sale process was initiated to secure clear title and a solvent future for the franchise. The emotional blow was immediate. A dynasty once synonymous with family stewardship now faced public humiliation. Longtime executives questioned their future. Stadium workers feared layoffs. Fans protested at games. Local businesses worried about summer crowds and downtown spending. The family's narrative collapsed in front of the cameras. Sale negotiations moved quickly. Buyers demanded clean balance sheets and governance reforms. They demanded limits on contingent liabilities and full disclosure of past transfers. The purchase price reflected both the franchise's intrinsic value and the need to extract the club from a web of claims. The final sale totaled approximately $2.1 billion. For the family, the transaction was not a windfall. It was a forced exit. Years of diverted cash and legal liabilities reduced what they could salvage. The economic impact rippled outward. New owners restructured debt. They paid down critical liabilities. They replaced management. Capital was injected to stabilize operations. Some staff were rehired under new terms. Others were let go. Sponsors renegotiated deals. Season ticket holders saw changes in pricing and benefits. The local economy absorbed both stabilization and realignment costs. Forensic economics helps explain exactly how the collapse occurred. Three mechanics stand out. First, commingling of personal and corporate funds. Family members treated the team like a private bank. Loans and advances were made with little formal documentation. Guarantees were given informally. Over time, these practices created latent claims against the club that were not reflected transparently in operating statements. Second, excessive leverage tied to illiquid value. Lenders funded borrowing based on future media rights and brand value. Those are real assets, but they are not immediate cash. When attendance dipped and short-term revenues flattened, the refinancing options dried up. The club's market value could not be converted quickly enough to meet pressing obligations. Third, governance failure. Independent oversight was weak. The board was too deferential. Audits were insufficiently rigorous. No firewall existed between family personal financing and club capital allocation. The absence of independent directors and robust controls allowed risky financial engineering to continue unchecked. Each of these mechanics amplified the others. Commingling hid leverage. Leverage eroded liquidity. Weak governance allowed both to persist. The result was predictable in forensic terms. An asset-rich but cash-poor enterprise that became uninsurable, unfinanceable under acceptable banking covenants, and ultimately subject to regulatory takeover. Human stories thread through every ledger entry. A longtime clubhouse manager lost his job after the custodians took over. A season ticket holder who had sat in the same seat for 30 years confronted new ownership at the first home game and asked why the family was gone. A vendor who had supplied food and logistics for decades found invoices unpaid for months. Players and coaches watched their long-term plans get collateralized. Behind numbers are paychecks, mortgages, and loyalties. When capital priorities shift to legal fees and settlements, people feel it. The televised parade footage that once symbolized triumph now plays as a visual counterpoint. Images of crowded stands juxtaposed with quiet courtrooms and empty boardrooms. Shot lists and documents show how money flowed in diagrams. Operating account to affiliated entity to family trust to personal creditor. Every arrow is a decision. Every decision has a human face. Accountants will point to missed covenants and questionable entries. Lawyers will point to guarantees signed under informal pressure. Fans will point to the loss of a name that had become a civic identity. Economists will point to the mismatch between valuation and liquidity. All are correct. Together, they describe a collapse that was both financial and cultural. Lessons are painful, but clear. First, never use a franchise as a personal ATM. If personal obligations are tied to corporate assets, the line of credit becomes a line of control. It is easy to sign a guarantee in a moment of stress. It is expensive to unwind one in a receivership. Second, independent governance matters. A strong, independent board that demands transparent reporting and resists conflicts of interest could have stopped many of the transfers that later became fatal. Regular external audits, public disclosures, and independent financial oversight are preventative medicine. Third, value on paper is not cash in hand. Long-term TV deals and brand value support valuation. They do not pay tomorrow's payroll. Liquidity management requires conservative stress testing under lower attendance and higher interest rates, not optimistic growth scenarios. Fourth, legal and personal shocks, like a divorce, can cascade through a corporate structure if the walls are porous. Estate planning must be executed without layering personal liabilities on top of corporate obligations. At the moment of the sale, closure was not total. Lawsuits continued. Creditors negotiated recovery plans. Some family members retained personal assets outside the club, but the dynasty's public stewardship ended. Ownership, decision-making, and the right to shape the club's legacy passed to new hands. That transition stabilized finances, but created a lasting rupture in civic identity. The community response was mixed. Some fans accepted new owners because they promised investment and stability. Others mourned the loss of a family era and feared commercialization. Local businesses recalibrated. The stadium remained a cultural hub, but the narrative around it changed. The club moved from a family crown jewel to a professionally managed asset. For other dynasties, the forensic checklist is simple and unforgiving. 1. Create a clear firewall between family finances and corporate capital. 2. Document every transfer, every loan, every guarantee, and make that documentation public to the board. 3. Stress test under pessimistic scenarios, not optimistic hopes. 4. Install independent directors with real authority. 5. Avoid personal obligations that can trigger instantaneous corporate encumbrance. If those safeguards are absent, risk compounds. Small liquidity gaps turn into forced refinancing. Refinancing turns into suits. Suits turn into regulators stepping in. Regulators force sales. The stakes climb at every step. That is the escalation map. In the end, the $2.1 billion sale bought stability. It did not buy back legacy. It did not erase the months of uncertainty, the layoffs, or the court transcripts that forever linked private turmoil to a public institution. The family's name remains on history books, but not on the ownership papers. The club continues to play. The banners still hang. The scoreboard still lights up. But stewardship changed hands by force, not choice. This isn't only a sports story. It is a cautionary tale about concentration of control, blurred financial boundaries, and the risk of valuing headline net worth over day-to-day solvency. The proud, emblematic asset became a wound when it was treated as both trophy and bank. A single document often sums it up. A loan agreement signed against a franchise's future receipts. On paper, it looked like leverage against growth. In practice, it tied the club to personal risk. That one signature is where governance should have stopped it. It didn't. The verdict for the family is final. The operational control is gone. The sale closed. The dynasty's practical authority disappeared. The lesson to other owners is clear and urgent. Protect the institution by protecting the balance sheet. Keep personal fights out of corporate books. Let independent controls do their work. Value and liquidity must be reconciled before creditors or regulators make that decision for you. This story closes with a simple image: a packed stadium at sunset, the crowd chanting, the scoreboard glowing. A family's portrait is removed from the wall. New portraits will follow. New leaders will sign new checks. The game goes on. The law of finance has spoken. The dynasty's pride became the collateral that ended it.